Most people try to save money, while successful people try to control capital. There's a difference. My name is Darius.
Carmen, I feel like you just get like super serious all of a sudden. Okay, so let's jump into the conversation at hand. We are going to talk about two different institutions in which you can control money. Or maybe you control money.
Have access to money.
You'll tell us in a minute. So let's jump into the video because we have option number one, which is the bank. So we'll put a big pretty bank on the screen so that you can see. We all know and love the bank, or maybe we don't love it, but we deal with it.
Right. So Carmen and I inside of our money school, we've been talking about liquidity because over each quarter, we talk about a different stage that people need to be in, which is protection, liquidity, growth, and lifestyle. And right now we're talking about liquidity inside of the money school. So the conversation for us that we want to have today is that when you have money sitting in your bank, that feels good, that feels safe. But what happens over time is that inflation quietly reduces the value of that money sitting there.
Yep.
Whereas when you have access to money like inside your cash value life insurance, what you have is you have money that you have available to you that you can deploy when the right opportunity presents itself to you.
So let's go back to the bank, shall we? When we use the bank, why do we use the bank in the first place? Is because we need a place to store our income. Right now, as far as we've been taught from a consumer standpoint, the bank is the only place where you can go and store your income when you get paid. And then when you need access to money, like Darius said, you want to buy a home, you want to buy a car, you want to pay for your education, we usually go back to the bank and say, hey, can I hold a few dollars so that I can pay for this thing?
Yeah.
And what we're doing, I don't know if you all are aware of this or not, is the reason why you can get a loan in the first place is because you are literally using your income as, let's call it, collateral to be able to qualify for these particular loans, which is why you have to apply, which is why the banks want to know how much money you got, how much income do you make, because they want to make sure that you can pay this back.
Right. Now, you can determine whether or not you should be borrowing the money from the bank in the first place by the interest rate. The higher the interest rate, the higher the risk, which means that they don't want to give you that money in the first place, so they're charging you an absurd amount of interest rate. So that should be your first telltale sign that maybe I shouldn't be getting this money in the first place.
We can stop there.
A bank is a storage facility. That's all it is. It's a storage facility. And what we should be doing is storing money there that we need quick access to. Banks aren't the end all be all when it's time to go get money. What you should be doing is have access to money, because that money sitting there is costing you for sitting there. And if you don't have the money, you go get it from the bank, they're going to charge you an arm and a leg to get access to it. Now, on the other hand, we have a different institution called a life insurance company, more specifically a dividend-paying whole life insurance policy. Now, the reason why we're talking about dividend-paying whole life insurance is because it's just the only difference between the two is the name outside of the door. And everybody who's healthy and
between the bank and the life insurance.
Between the bank and the life
I
insurance
just want to
company.
clarify, yeah.
And everybody should have life insurance because one day they're going to pass away, and there's people who you are supporting based on your existence and you working. Even if you're getting Social Security, there's somebody that's depending on you in the event that you pass away and that money stops. Now, the reason why specifically we're talking about life insurance is because everybody has access to it, regardless of whether or not they are multimillionaires or worth a couple $100,000. Everybody has access to it, and everybody has access to these funds at the same interest rate, regardless of how much money you make.
Well, let me jump in here because I want to make sure that we don't skip a step, because it's easy for us to talk about it because we talk about this all the time. But I want to just take a moment before Darius cranks up the notch on you just a little bit. No, that was fine. Amazing explanation. But we need to step back in just a moment because we're comparing the banks and a life insurance company. We're specifically talking about, like Darius said, we're talking about a mutual life insurance company. And when we own products with this life insurance company, this allows us to have access to capital. Same thing we do at the bank, right? At the bank, we have access to products, checking account, saving account. Maybe we have some loans out there. We have a relationship with them, right? So what we're doing is comparing the relationships that we have with these financial institutions. When we own a life insurance, a whole life insurance policy with a mutual dividend-paying company, that allows us to have the relationship where we can literally leverage the product of a life insurance policy, whole life specifically, to use it as collateral to get access to the funds from the whole life insurance company. So I just want to make sure that was clear.
Yes, that's clear.
Now you go.
So
Or back to what?
So the
back
point,
to the regular schedule.
the point that I'm trying to make is that life insurance sits inside of a system. When you access those funds, you're accessing it because there's an opportunity that presents itself where you can make more money from the investment. When you are getting money from the bank, you're getting money from their system. So the system that we're creating is protection, liquidity, growth, and then lifestyle. Lifestyle comes when you are making money from your money. The banks are making money from your money because you're paying them interest. So what we're trying to press upon you is the fact that our thinking up until now has been to save money, save money, save money. But what are we doing with that money that we're saved? We should be saving for a specific purpose. And that purpose that we're saving is to make more money.
Mm-hmm. And going forward with that, the idea too is we want our money to be able to do multiple things for us at the same time. If we keep our money in the bank in a saving account, for example, it's only sitting there.
Yes.
Yes, it is earning compound interest, but the point is it has to stay there. I can't touch it in order for me to really benefit from that compound interest. Whereas I look at another product or another relationship that I could have with a financial institution, like owning a whole life insurance policy, is now my money is now I'm protecting my income because I've purchased a product that is giving me some income protection, and then I have access to liquidity. And it's also earning the compound interest. So now my money is doing more things for me for the same dollar that essentially that I would put in the saving account. So when opportunities arise and I can invest, I can utilize my policy as collateral, borrow from the life insurance company, and now I am not depleting my liquidity. I'm using OPM or other people's money from the life insurance company to invest. And then when that money comes back, I'm paying back the life insurance company and holding on to the interest.
Right.
That's how this whole thing works. And this is how we get to own more and more control with this process because we are in control of the financing process.
Right. And I think life insurance is a foundational step because everybody, as long as you're healthy and you have the funds, you can get a life insurance policy. But it's not the only asset that exists. And I'm very aware of that. You have real estate that you can you can leverage and access funds. You have your stock market that you can leverage and access funds. But everybody's not savvy in those different things, in those different asset classes. But when it comes to life insurance, the only thing you have to do is be a warm body and have funds. And as long as you pay your premium or have access to your premium, you can access that cash so that you can deploy into other assets like real estate, like the market, where you can then still access those funds.
Mm-hmm. Wealth Nation, what we want to do is to challenge you to think about the relationships that you have in your life as it pertains to your money. So what accounts do you have out there? Go research them. Your retirement accounts, maybe your life insurance accounts, maybe your banking accounts. Anything where your money is parked, you need to go back and make sure that you understand exactly what's happening in that account, why you have it in the first place, and what is it doing for you, and what is it doing for the other person that's involved. That's some things that we tend to forget is, okay, great, this is benefiting me, but how much is the other side of this actually making? And if they're making more money than you and it's your money, you might need to look into this. Right. The idea behind what we're talking about today is just challenging the relationship between the banks and a life insurance company. They are not the same, right? Because they both provide very different products and services. But the idea is you can use both of these financial institutions to benefit financially. You just have to understand how to play this game.
At the end of the day, when you borrow money from the banks are going to be able to take on a level of risk, which is why they have Federal Reserve banking in the first place, which means they can lend out significantly more money than they have. But the idea is to have access to money within a system. And the system that we use is protection first, liquidity, which you get with a life insurance policy. You protect your family with the death benefit and you get access to cash without actually having that cash sitting inside your bank account. You get access to it, and then you can deploy that capital into something that's going to make you more money, which is the growth phase. And by doing these 3 steps, then you get to benefit from lifestyle. This is a system that these policies are a part of. The policy itself isn't the end all be all. It's the asset that you purchase using the cash value from your policy that's going to be putting money back into the system so that this whole system can work. without you. There's a framework that you're working towards.
And with everything that Darius was just saying, as we go back to the conversation of having money that sits idle versus having access to liquidity, the idea is, where do you want your money to be placed? So reevaluate, like we said, reassess where your money is, because if money is sitting, it's not serving you, and then figure out ways that you can be more efficient with your money by creating liquidity by creating a liquidity facility so that you can then deploy those funds to help make you more money.
Right. Now, don't just create this system for yourself. We can also help you create this system. So check out our webinar below so that you can get our entire Wealth Nation framework.
And don't forget to own your own lifestyle.
Or someone else will.